Unlike the Fed or the Bank of England, the European Central Bank, which already has negative rates, is holding its interest rates steady, and it's using credit market support through bond purchases and low-cost loans, LTROs, and really just making them unlimited. Christine Lagarde, the ECB president, says the virus has dealt a major shock to the European economy.
Even if ultimately temporary by nature, it will have a significant impact on economic activity. In particular, it will slow down production as a result of disrupted supply chains and reduce domestic and foreign demand, especially through the adverse impact of the necessary containment measures.
David Kelly's with me, the Chief Global Strategist at JP Morgan Asset Management from Newtown in Massachusetts. Let me just test you can hear me, David. Can you hear me?
Yes, I can. Yes, I can.
Good. So let's get straight to this. Let's start with the ECB and work backwards to the other central banks. Was the ECB right not to cut rates, but to use these other facilities so that, firstly, it's liquidity to the market, and secondly, it creates bank lending by lowering reserve requirements?
Yes, I think so. I mean, the reality is, of course, that cutting rates from negative levels probably doesn't do any good, probably does more harm than good, as actually was the case before this crisis. But I think what we really need to see is a fiscal response. I think this is true worldwide. You have to both be very tough in containing the virus, but then also correspondingly give people the disposable income to allow demand overall in the economy to stay strong enough to limit the downside for the global economy. That's true for economies around the world. So it's really not about the ECB. I think it's about governments in Europe and governments around the world to try and provide that aid.
We said at the time in 2011 and 12 that if the central banks, they were out of ammunition in the sense of they'd reduced so far back then that there wouldn't be the headroom to reduce if there was another crisis. That's exactly what's happened. Can we now say that central banks, other than liquidity for the markets, are busted?
Well, yes, I think that's right. I mean, that's why, I think the Federal Reserve was wrong, for example, to cut interest rates last year when we didn't have a problem, because you want to leave some ammunition in the chamber if you do have a problem. But again, there's not much that central banks can do here. This is not really an issue of lending. This is an issue of trying to, the economy is adjusting to a social distancing version of an economy. Now, actually, in the long run, a social distancing version of the economy could also work at full employment. The problem is that the adjustment is very painful, even if it's temporary. And that's where I think governments have to step into the gap to try to help particularly low-income workers find a way of weathering this storm.
I'm looking at bonds at the moment. The 10-year bond, the yield went down again. We're seeing bond yields going down. Clearly that flight to quality continues. The 10-year looks like it's 0.73. There had actually been, yesterday, they actually went up.
Well, yes, and I think there are some problems in the Treasury market. I mean, these are very volatile markets. You've got to find somebody to buy these bonds. But I think in general, if central banks are easing, I do expect to see low long-term interest rates. That doesn't help the economy. But what it does do is it means for long-term investors, it makes bonds less attractive. And I think that is ultimately very important because at some stage, these markets will fall far enough that people say, well, yeah, I know 2020 is a bust, but 2021 should be the first year of recovery. So if I'm owning for the long run, do I really want to own bonds that are paying me well below the rate of inflation, or do I want to get back into equities where I've got a better chance of growing in the long run? So I think it does do some good in terms of putting a floor under the equity market ultimately.
I was on the stock exchange floor earlier in the week, and one trader said to me, 2,200's the number. If 2,200 on the Dow is hit and missed, and fallen through, then all bets are off. Well, as you can see from the number, 2,200's been and gone. What's your next support level?
I don't work that way. I honestly think that you can't tell because these markets have no. But this is really important because the last big crisis in the U.S. was 11 years ago. There's so much that has changed in the nature of markets between now and then that you can't make that call. But the real question is not at what point you step in, but what do you buy? And I think it's very important to buy things that make sense, companies that can weather a downturn but also thrive in an upturn.
Good to have you with us, sir. Thank you. Thank you.